You need to shift 7 specific assets before January 2027 arrives, or you risk handing the IRS up to $45,000. There is a day approaching that will arrive whether you are prepared for it or not. January 1st, 2027. This is not a proposal. This is not up for debate. It is the exact morning the tax laws reset on 7 distinct assets that countless Americans own right now, completely unaware of what is coming for them. One of the best investors of our time famously noted that price is what you pay, while value is what you actually receive. What I am going to reveal to you today is the heavy price of sitting still. For a typical retired couple holding these 7 assets, that penalty is $45,000 just in the first year. This loss does not happen because they violated the law or picked a terrible stock. It happens simply because they took no action as time marched on. I have spent the last few weeks digging deep into the new tax legislation, the 2026 IRS enforcement plans, and the Treasury's updated inflation numbers. What I uncovered is a setup that heavily favors those who know the rules and silently drains wealth from everyone else. The government will not mail you a heads up. They simply bury the changes in a massive 200-page document and expect you to figure it out. The vast majority of people never do. That $45,000 drop is not some extreme worst-case example. It is the mathematically projected first-year loss for a normal retired couple with a standard portfolio. Here is how it breaks down. $2,000 lost from cash eaten by inflation. $6,000 in easily avoidable IRA taxes. $7,500 left on the table from missed capital gains harvesting. $30,000 swallowed by real estate recapture. A $4,000 life insurance mistake, $3,000 in Social Security taxes, and $2,500 tied up in probate and frozen account fees. If you only own 3 of the 7 items on this list, a piece of that financial hit is coming your way unless you take action before the deadline passes. Today, we are going to walk through every single one of them. Let us start with the money sitting in your bank account right this second. This is the cash you think is totally secure, yet it is silently being drained by inflation every single day. From there, we will look at the traditional IRA, which is arguably the riskiest asset to hold in retirement, exactly because it looks so safe on your monthly statement. Next, we look at your brokerage account, where a 0% tax window is open right now but shuts permanently on December 31st. The fourth asset involves your real estate, things like rental homes, vacation properties, or inherited commercial spaces, where depreciation rules and exchange deadlines trigger the biggest one-year tax burden most retirees will ever see. The fifth issue touches all of this, your hard-earned Social Security benefits, which lawmakers have been quietly taxing since 1983, using limits that have never once been updated for inflation. Finally, we will cover the hidden traps in your life insurance and joint bank accounts. 5 key lessons, 7 assets, 1 strict deadline, and so much money on the line that a certain famous investor from Omaha would remind you that the absolute costliest choice you can make right now is doing nothing. There is a reality the banking industry will never willingly share with you, and it looks a lot like this. You put in 40 years of hard work. You saved your money diligently. You followed every rule the financial rule books laid out. And now, in your retirement years, the cash you parked in the bank for safekeeping is yielding 0.5%, while inflation cruises at 3%. On top of that, the government has set up an automatic tracking system around that very account, treating your everyday deposits the same way a police officer treats a prime suspect. You are not a criminal, you are simply retired. But the system cannot always tell the difference, and you are the one left paying the price for that confusion. Let us begin with a figure that should make everyone paying attention sit right up. The $10,000 mark that forces your bank to file a mandatory report to the federal government has not been updated since 1970, not a single time in 55 years. Back in 1970, $10,000 was massive. It was more than a typical family made in a whole year. If we adjusted that for today's inflation, that threshold should be around $80,000. But it is not. It remains stuck at $10,000, right where lawmakers left it over half a century ago. Because of this, every day, banks all over the country are automatically filing currency transaction reports on older Americans who simply deposited cash from selling a used car, a modest inheritance, or a few CDs that happened to mature on the same Tuesday. The document is known as a FinCEN Form 104. The bank sends it in automatically. They do not ask if it is okay, and they do not mail you a receipt. Your name just goes into a tracking database run by the Financial Crimes Enforcement Network, and you are completely in the dark. A lot of folks hear this and think, well, I have done nothing wrong, so why should I care? They are totally right that they have done nothing wrong, but they are dead wrong to think it does not matter. The surveillance is not even the most costly part of this trap. The reporting just feels like a slap in the face. The truly expensive part is what that legendary investor calls the invisible tax, the quiet, steady erosion of your buying power that happens when cash just sits there. Imagine you have $50,000 in a basic savings account paying out 0.5%, while inflation hums along at 3%. You are actively losing $1,250 in real spending power every single year. You will never see a minus sign on your bank statement. In fact, your balance will show a tiny increase from the interest. But the actual amount of groceries, gas, and services that money can buy drops by $1,250 year after year, as steady as a ticking clock. Fast forward 5 years, and you have lost over $6,000. Give it 10 years, and it is a $12,000 loss. The account balance looks fine, but your retirement security is bleeding out. The second hidden danger with holding cash is a federal crime that barely anyone realizes is on the books. It is known as structuring. Let us say you want to deposit $15,000. The bank is going to file that currency report. A lot of people naturally think, I will just split it up. I will drop off $7,500 on Monday and another $7,500 on Thursday. Problem solved, except it is not solved. It is a federal offense. Splitting a deposit into smaller chunks just to dodge that $10,000 reporting trigger is classified as structuring, and it comes with a penalty of up to 5 years in federal prison. The authorities do not even have to prove you were covering up dirty money. They just have to prove you tried to bypass the paperwork. A retired guy who sells a piece of land and splits the cash at the teller window to save time on forms has technically committed a felony. This rule was drafted in 1970 to catch drug runners. Today, it catches grandmothers who just do not understand a banking rule nobody ever bothered to teach them. The fix for this cash problem is simple, and it requires no guessing games, no trying to time the stock market, and no confusing spreadsheets. If you are sitting on a large pile of cash that you do not need to spend immediately, move it over to Treasury Direct and buy I-bonds. These bonds pay a mixed rate that is directly linked to inflation, plus a set baseline, which means the invisible inflation tax is canceled out by the bond's return itself. If you need something easier to access, look into a Treasury money market fund. Right now, they are paying around 4.3%. They charge no state income tax on the gains, and they are fully backed by the U.S. government. If you absolutely must keep the cash perfectly liquid for emergencies, opening a high-yield savings account at an online bank that pays 4% or higher is the bare minimum you should accept in this current environment. The math is clear. A 4% return on $50,000, even after the IRS takes a 12% cut for taxes, still leaves you with roughly $1,700 in clear profit each year. That is $1,450 more than you would get leaving it in that standard local bank account. And more importantly, that is $1,450 that inflation cannot reach into your wallet and steal while you are sleeping. There is a specific asset parked in millions of retirement accounts across America today that appears at first glance to be the most secure investment imaginable. You get your statement every 3 months, and there is a healthy balance printed at the top. You have watched it grow for decades. The money you put in gave you a nice tax deduction, which felt like a free bonus from the IRS back in the day. Plus, practically every financial advisor on Wall Street spent the last 30 years urging you to max it out every single year. But here's the secret almost no one let you in on. Every dollar inside that account has an invisible tax bill attached to it, and the cost is not locked in. The government gets to decide the price tag in the exact year they legally force you to pull the money out, using whatever tax rate they decide applies at that future date. That is no longer an investment. That is a joint venture with the IRS where they have the power to dictate the rules after the game has already been played. The trigger that makes this so hazardous is known as the Required Minimum Distribution, or RMD. Based on current regulations, if you turn 73 on or after January 1st of 2023, federal law mandates that you must start pulling cash out of your traditional IRA annually, starting at age 73. You do not get a say in whether you actually need the cash. You cannot wait for the stock market to bounce back if it is having a bad year. You do not get to pick a year when your tax bracket is low. The IRS hands you a life expectancy chart, and you have to divide your December 31st balance by their specific number to figure out the exact minimum amount you are forced to withdraw and declare as ordinary income. For someone who is 73, that magic divisor is 26.5. If you have a $500,000 IRA, your very first forced withdrawal is $18,868, and every cent of that is taxed as ordinary income, based on whatever your highest tax rate happens to be. But the tax on that specific withdrawal is just the tip of the iceberg. That $18,000 does not just sit in a vacuum on your tax return. It gets piled on top of all the other money you make, triggering a massive domino effect. That forced payout drives your adjusted gross income up, which in turn drags more of your Social Security checks into the taxable category, which then bumps up your Medicare IRMAA premiums 2 years down the road and can even bump your long-term capital gains out of the 0% bracket and up to 15%. One single mandatory withdrawal from one account impacts every other dime you bring in, all at the same time. More often than not, the collateral tax damage is far worse than the tax on the distribution itself. Picture a married couple, both 69 years old, bringing in $36,000 a year from Social Security and sitting on a $600,000 traditional IRA. They also get a $40,000 pension. Before they even touch that IRA, the number the government looks at to tax their Social Security, called their provisional income, is already at $58,000. That is well past the $44,000 limit for married couples, meaning 85% of their Social Security is already exposed to taxes. Now, fast forward to age 73 and add in that required minimum distribution. $600,000 divided by 26.5 equals $22,641. That forced payout drives their modified adjusted gross income past $93,000, putting them less than $2,000 away from hitting the 22% federal tax bracket. One surprise dividend, a tiny side hustle, or a forgotten CD paying interest, and suddenly every extra dollar is being taxed at 22 cents instead of 12 cents. But the scenario that should truly worry every married couple tuning in is what happens when one spouse passes away. The surviving partner now has to file their taxes as a single person. In 2026, the 12% bracket for single filers caps out at $47,150. That exact same mix of income that was perfectly fine on a joint tax return, the pension, the forced IRA withdrawal, and the taxable Social Security now generates over $63,000 of taxable income on a single return. That shoves over $16,000 directly into the 22% tax bracket. We are talking about an extra $3,200 in federal taxes every single year. The underlying money never changed. Only the filing status shifted, making the tax brackets much tighter. That seemingly safe IRA turns into a brutal tax trap for the surviving spouse. Fortunately, you have a window to defuse this trap right now, but it is not going to stay open forever. If your current taxable income keeps you inside that 12% bracket, you have the room to convert funds from your traditional IRA into a Roth IRA, paying just 12 cents on every dollar you move. Once that money is inside the Roth, it escapes the required minimum distribution system forever. It will never trigger a forced withdrawal. It will never drag your Social Security into a higher tax bracket. It will never cause your Medicare premiums to spike. It grows completely tax-free for the rest of your life and your spouse's life. Plus, it passes down to your kids without any strings or forced withdrawals attached to it. Thanks to recent legislation, taxpayers over 65 currently get an extra $6,000 standard deduction through the 2028 tax year, which opens up that 12% bracket by that exact amount. But after 2028, unless Washington changes the rules again, that favorable window shrinks. Conversions become much more expensive, and this incredible opportunity closes. When most retirees check their standard brokerage account, they feel pretty good about it. The stocks have been sitting there for years. The index funds have steadily compounded. The unrealized gains section displays a big number that proves you were disciplined and patient. And somewhere in the back of your head is an old piece of conventional wisdom passed around by financial planners for decades. Never sell appreciated assets until you pass away. Let the step-up in basis wipe out the capital gains tax entirely, passing the whole account to your heirs without the IRS taking a single dime of that growth. It sounds like a beautifully simple strategy. The problem is, it is dangerously incomplete, because it relies on two assumptions that are usually completely false. First, it assumes you will never actually need to spend that money while you are alive. And second, it assumes the account is legally titled the right way. When both of those assumptions turn out to be wrong simultaneously, it can easily cost you tens of thousands of dollars. Let us look at the titling issue first, because it is the one that catches people off guard and drains their wallets when they find out too late. The vast majority of married couples set up their brokerage accounts as joint tenants with right of survivorship. It sounds great on paper. It sounds like the money smoothly transfers to the surviving partner, which is technically true. But in a common law state, which covers most of the country, joint tenancy means both spouses legally own exactly half of the assets. When the first spouse passes, only their half gets that magical step up in basis to whatever the market value is on the day they died. The surviving spouse's half is stuck with its original purchase price, which might go back 20 or 30 years to a time when those stocks were a fraction of their current value. Let us break down the real-world math. Imagine a couple with a joint brokerage account worth $300,000 today. They originally paid $100,000 for all those investments, meaning they have $200,000 in unrealized profit. The husband passes away. His half, which is $150,000, gets the step up in basis. Her half is stuck with the original basis from back in 1998. When she goes to sell the portfolio 6 months later to cover some medical bills, she does not owe zero in taxes. She owes capital gains tax on $100,000 of profit that never received the step up. If you combine federal and state taxes at a conservative 15%, she is looking at a $15,000 to $18,000 tax bill on a totally necessary withdrawal from an account she thought was completely shielded. Fixing this does not require a lawyer, a courtroom, or any expensive fees. All it takes is a simple signature at your brokerage firm to change the title of the account from joint ownership into the individual name of the older spouse or the spouse who is in poorer health. Shifting the account from joint to individual does not trigger a tax event. It does not force you to realize capital gains. You do not even have to file a gift tax return if it is below the annual limits. It takes about 2 business days to finalize, and it can permanently wipe out $15,000 or more in future taxes that the surviving spouse would otherwise have to pay on a nest egg they spent their whole life growing. However, as crucial as fixing the title is, it is actually not the most urgent move you need to make inside your brokerage account today. That prize goes to the 0% long-term capital gains bracket. This is a loophole in the tax code that acts like an annual harvesting window. It cracks open every January 1st and slams shut on December 31st. Whatever gains you fail to lock in before it closes are gone until next year, and that assumes your income situation even qualifies you next time around. For married couples filing a joint return in 2026, long-term capital gains on investments you have held for more than a year are taxed at exactly 0% at the federal level, as long as your total taxable income stays under $98,900. You heard that right, 0%. The federal government takes absolutely nothing from your profits if your overall income remains below that line. And here is the best part. Unlike the wash sale rule, which stops you from selling a stock at a loss and buying it right back within 30 days, there is no such restriction for gains. You can sell a winning stock, lock in the profit at a 0% tax rate, and buy the exact same stock the very next morning, establishing a brand new, much higher cost basis. You have permanently captured that growth tax-free. Any future taxes on that specific amount of appreciation are completely wiped out. Think about how powerful this is in the real world for a retired couple with $60,000 in regular taxable income and $30,000 of unrealized profits sitting in their portfolio. They still have $38,900 of room left inside that 0% tax bracket. They can sell those assets, harvest the entire $30,000 gain this year without paying a dime in federal taxes, and buy the exact same positions back a minute later. Doing this eliminates what would have eventually been a $4,500 tax bill if they had to pay the standard 15% rate down the road. When they look at their account the next morning, their investments look exactly the same, but the tax savings are locked in forever. The only catch is that you must execute this move before December 31st. Once January 1st hits, the brackets reset, and your income situation might never line up this perfectly again. Out of all 7 assets we are looking at, real estate involves the highest amounts of money, the strictest deadlines, and the biggest mismatch between what retirees think happens and what the IRS actually dictates. Landlords, owners of vacation homes, or those who inherited a commercial space usually feel pretty confident about these holdings. The values have gone up. The rental income covered the mortgage. The depreciation write-offs lowered your taxes for years. And you have probably heard somewhere along the line that property is one of the most reliable wealth-building engines available. While that is all accurate, there is another side to the story. Every single one of those depreciation write-offs the government handed you over the years has been carefully tracked by the IRS. The second you sell that property, they want that money back. And they do not care how old you are, what your current retirement income looks like, or that you are no longer working. The IRS charges a flat 25% tax on every dollar of depreciation you ever claimed, no matter how low your regular tax bracket is when you make the sale. This hidden trap is called depreciation recapture, and it functions as a stealth tax buried inside what you think is just a standard capital gains deal. If you own a residential rental, the IRS makes you write off the building structure over 27.5 years. For commercial assets, it is 39 years. Every year you own the place, that deduction drops your taxable income. For instance, on a $200,000 rental building, you get roughly $7,270 in annual write-offs. Over 20 years, that adds up to $145,000 in total deductions used to lower your income tax. But when you sell the property, the IRS claws back that full $145,000 at a flat 25% rate. That amounts to a $36,250 recapture tax bill before they even begin to calculate your standard capital gains tax on top of it. Most retirees selling an investment property for the first time show up to the closing table thinking they only have to worry about capital gains. They completely miss the fact that they owe a separate tax that is likely much higher than their standard 12% retirement tax bracket. The closing agent will not explain this to you. Your real estate agent will not mention it. It will not be clearly spelled out on your settlement forms. You will simply find out the following April, when your tax professional finishes your return. By then, the proceeds from the sale have usually been spent, locked into other investments, or gifted to family members who thought the deal was entirely done. The primary tool the tax code offers to legally delay both capital gains and depreciation recapture is a 1031 exchange, named after the specific rule in the tax code that allows it. Done correctly, a 1031 exchange lets you sell your investment property and shift all the profits into a new similar property without triggering a single dollar of capital gains or recapture tax during the year of the sale. Both of those tax bills are kicked down the road into the new property, and they will stay paused as long as you keep rolling them into new exchanges. If you hold on to that final replacement property until you pass away, your heirs get a step up in basis that wipes out the built-up gains entirely. This means the lifetime of accumulated taxes simply vanishes, and nobody ever has to pay them. However, the 1031 exchange is tied to two of the most rigid deadlines in the entire tax system. If you miss either one by even 24 hours, the whole exchange collapses, and your full tax bill becomes due instantly. From the exact day your property sale closes, you have precisely 45 calendar days to identify your target replacement properties in writing to your qualified intermediary. Keep in mind, these are calendar days, not business days. Weekends and holidays count against your clock. That 45-day window never changes unless there is a major federal disaster declared in your specific town. After you lock in those targets, you have a total of 180 calendar days from that initial closing date to fully complete the purchase of the new property. If that new deal closes on day 181, your exchange fails, and the deferred tax is due immediately, plus interest. But the mistake that ruins more exchanges than any deadline is failing to have a qualified intermediary in place before your original property sale closes. Not after, and not at the exact same time. It has to be before, because that intermediary must hold the sale money in a separate account so the cash never touches your hands. If that money hits your personal bank account for even an hour, the IRS considers it a constructive receipt, which completely invalidates the exchange and makes the entire profit taxable that year. Take the example of a retiree in Arizona who sold a rental property in early 2026. He took the money at closing, planning to wire it over to an exchange account the next week. The moment those funds landed in his personal checking account, his exchange was dead. He wound up owing $52,000 in combined capital gains and recapture taxes on a property he sold for $280,000. His strategy was sound, but his timing was off by just 72 hours. If you are thinking about selling any investment real estate around January 1st, 2027, you need to bring in a qualified intermediary before the property even goes on the market, not after you accept an offer or sign a contract. The fee for an intermediary usually ranges between $800 and $1,500, but the tax bill it saves you can easily hit six figures. On the other hand, if you do not plan on selling and just want to shield your family from the massive built-in taxes when you pass away, placing the property into a revocable living trust does the trick. It protects your heirs without triggering any current taxes, without altering how you run the property today, and without changing your current depreciation deductions. Our next topics focus on life insurance, cash value, Social Security, joint banking, and payable on death setups. These final three items have something crucial in common. They do not look like traditional investments. One is a policy you bought years ago for your family's peace of mind. Another is a monthly check from the government that you earned over a lifetime of working. And the last is a standard checking account where your money lands every month. They feel completely normal and familiar, which is exactly why they are the most likely to hit your family with a surprise tax bill, a frozen account, or a legal headache at the worst possible time. Let us look at life insurance cash value first, because the confusion here is almost universal, and the financial shock can be brutal. Most retirees holding permanent or universal life insurance think that cash value is theirs to take out tax-free whenever they want. The insurance companies do not help. Their annual updates show a growing balance without mentioning taxes. But there is a massive difference between tax-free and tax-deferred. Using the money the wrong way can suddenly add $40,000 or $50,000 of taxable income to your return, pushing you right out of the comfortable 12% bracket. The cash value inside these policies grows tax-deferred, not tax-free. When you take money out, the IRS uses a last-in, first-out rule. This means your investment gains come out before your original principal. If your policy holds $50,000 in cash value and $30,000 of that is growth, that first $30,000 you withdraw is fully taxed as regular income that year. It does not matter if it took 25 years to build up. The moment you take it out, it counts as income earned this year, stacking on top of everything else. The biggest damage occurs when a policy lapses. If the premiums get too high and you let the coverage drop without a formal surrender, the IRS treats it as if you received all those gains at once. For example, a 71-year-old man in Texas had to let his universal life policy go because the monthly bills outgrew his fixed budget. His policy had $65,000 in cash value, with $42,000 in gains. Letting it lapse triggered $42,000 in taxable income in a single year. He never got a dime of cash, but the IRS sent a tax form for money he never saw or spent, raising his tax bill by almost $10,000. The solution is a policy loan, which is one of the most overlooked planning tools available. When you borrow against your policy's cash value, instead of withdrawing it, the money is not considered taxable income. It does not show up on your tax return. It does not tax your Social Security, and it does not spike your Medicare premiums. The loan accumulates interest, usually between 5% and 8%, but that is much lower than paying a 22% or 24% tax rate on a withdrawal. If the loan is still active when you pass away, the death benefit simply pays it off, and the remaining tax-free balance goes to your family. Now let us talk about Social Security, an asset where the unfairness is obvious and the fix links back to everything else we have covered. Up to 85% of your Social Security benefits can be hit with federal income tax. This is not because you are wealthy. It is because the income limits that trigger this tax were set back in 1983 and have never changed for inflation in over 40 years. The starting threshold for married couples is just $32,000, and the upper limit where 85% becomes taxable is a mere $44,000. Back in 1983, only high earners hit those numbers. Today, because everything else has gone up with inflation while the limits stayed frozen, nearly every retiree with a basic pension and a modest IRA passes that upper limit automatically. The IRS uses a formula called provisional income to track this. Figuring this out is the single most important math problem you need to solve before the year ends. Your provisional income is your adjusted gross income, plus any tax-free interest from municipal bonds, plus exactly half of your yearly Social Security benefits. If that total goes over $44,000 for a married couple, 85 cents of every Social Security dollar is counted as taxable income. Take a couple with a $40,000 pension and $36,000 in Social Security. Their provisional income is already $58,000 before they even touch an IRA. This means 85% of their benefits are already taxed. At this point, every extra dollar they pull from a traditional IRA or claim in capital gains does double damage. You pay tax on that dollar, and it triggers more tax on your Social Security check. The strategy here takes discipline but is very clear. Roth IRA distributions do not count toward provisional income. Neither do policy loans or unredeemed I-bond interest. By drawing from these tax-neutral assets first, you keep your overall tax profile as low as possible and shield the benefits you spent your career earning. Shifting even a little income from a traditional IRA withdrawal to a Roth withdrawal lowers your taxable Social Security dollar for dollar, saving you direct taxes and preventing higher Medicare premiums down the road. The final asset is less about complex investing and more about simple household paperwork, your joint bank account and the beneficiary forms attached to it. When things go wrong in your later retirement years, these documents can become the most dangerous papers in your financial life. Under FINRA Rule 4512, financial institutions can temporarily freeze withdrawals from accounts owned by adults age 65 or older if they suspect any form of financial exploitation. This hold can last for 15 business days and can be doubled by a court or state regulator. During this time, your money is completely locked up, no matter how badly you need it or how urgent the bill is. Checks will bounce, automatic bills will fail, and the bank cannot be sued because the law allows them to do this based purely on suspicion. A 78-year-old woman in Michigan added her nephew to her checking account so he could help pay bills while she was in the hospital. The bank's security system flagged the new joint owner along with a $12,000 check to a home contractor. They froze the entire account for 15 days. Her Social Security check arrived a couple of days later and was locked up instantly. She could not pay her rent or buy her medication, and it took 3 days of stressful phone calls to straighten it out. There was no fraud, the contractor was real, and the nephew was just helping, but the system could not tell the difference. Fixing this is as simple as calling your banks and double-checking your beneficiary forms. If the named beneficiary has passed away, if it is an ex-spouse from a marriage that ended years ago, or if it no longer fits your family situation, you need to update it immediately. The payable on death designation on that bank form completely overrides your will. It will hand your money to whoever is listed on that card, no matter what your current wishes are. Taking action on these details before the deadline is the ultimate way to protect what you have spent a lifetime building.